welcome everyone. Happy Tuesday. Thank you so much for joining us this morning or afternoon, depending on where you are. My name is Lauren Wells, and I run investor relations here at Seveney. I know over the last few months, I have had the pleasure of speaking with some of you. And if I haven't spoken with you at this point, and this is your first time seeing/meeting me, I hope to connect with you soon. So I am joined today by Chris, our CEO and founder of Seveney Investments. How are you doing today, Chris?
I'm doing well. How are you doing, Lauren?
Pretty good. I was just saying how this crazy heat wave, for those of you that don't know, we're based out of Virginia. I am located in California, and this crazy heat wave we've been having just broke finally. So it's been amazing. So I'm doing great, not waking up to 90-degree weather. So today we are going to talk about mortgage note investing 101 is what we titled it. Really, what are mortgage notes? What's a note? What does it mean when a note is performing versus non-performing? How do investors make money? And then we're also going to cover some of the potential risks and how we at Seveney mitigate those risks. So I know, for some of you joining us, you might already have some familiarity behind mortgage notes, but bear with us. We want to make sure that we are, educating everyone, and also we will get to those risks, which I know some of you are also interested in learning how we mitigate those risks. So with that being said, let's kind of start with what is a mortgage note? Chris.
Yes, I can answer this one. So a mortgage note it's a real estate note. It's a debt instrument, also known as a promissory note or an IOU. It's essentially a obligation to pay back a loan. But when you're dealing with a mortgage note, the next half of it is that the IOU is backed by something. It's secured. So I'll let you I think that rolls into the next component of how is that?
Yeah. So when you're purchasing notes, do you own the property? Or are you investing in, how does that work? Can you explain a little bit more about that?
Oh, absolutely. So you don't own the property. And that's one of the things I think is most challenging for investors. For anybody who's owned a home before that's had a mortgage on it, your lender is somebody you pay money to pay back that loan. And we are just filling in the shoes of the lender. So we are acquiring that note. And along with that note, we also acquire what's called the mortgage, because many people think a mortgage and note are the same thing, or they're, it's one document. It's actually two. There's a document that is a note that is typically a 3-page document. That's an IOU that says, Lauren Wells, we're giving you $100,000 at 5% interest over 30 years, and your payment is Y. Now, the reason there's a mortgage that gets attached to that is if you were to stop paying that loan because it's such a high risk, high dollar loan, and you're getting at such a low rate, the lender's like, I need something to secure that loan. So the property then is what's secured by it. So if the loan were to go into a default situation, the mortgage is kind of the terms that allow the lender to step in.
So in short, no, you do not own the property, but all of the notes are secured by actual real estate.
Yeah.
So physical real estate.
Mm-hmm.
And what types of notes are there? There's two types. There's performing and non-performing. So when we talk about performing, what does that mean, Chris?
Performing means the loan is current. So the borrower has been making their payments, is a performing loan. Typically, sometimes they might get within like a 30-day delinquency. Those are still considered performing. When it hits the non-performing cycle, it's when they're more than 90 days past due. And we have loans that we've seen that are as much as 3, 5, 7 years past due, to give people an idea of some types of the delinquencies that we see. It's more common for us to see loans that are 2 to 3 years delinquent than it is to see loans that are, 120 to 180 days delinquent.
Yeah. And when we talk about, acquiring notes, just to back up a little bit here, we purchase notes from who? Who's selling these? I think that's something I get a lot is well, where are you getting these notes? People sell these? It's kind of, this is a very niche industry within real estate. So kind of, can you elaborate on that a little bit?
Yeah. And I think why it's people wonder that is people probably never realize that their loans get sold all the time. And you may have gotten a notice to send your payments to a new location or something. That's typically because your loan has gotten sold.
Yeah, that's happened to us quite a first times.
Yeah.
And yeah.
Oh, go ahead.
No, I
Okay.
didn't know it was a thing. I remember when our first loan got sold, I called and was like, what's going on? We've been making our payments. Kind of freaked me out, but yeah, come to find it's pretty common.
And what ends up happening is, in many instances, the ultra large hedge funds, and when we say large, we're talking billions to tens of billions, they buy these and they'll call them tranches or buckets, where they're buying tens of thousands of these loans at a time, whether they're buying them from a government sponsored entity or wherever they're getting from. And then essentially it's kind of, I'll use the term, the trickle down effect, where they will buy a large bulk of them, take certain ones they want to keep, and then they peel them off and sell them off to the secondary market. Another large fund may step in and buy them and then sell them down to another secondary market. And we are in that mix of the secondary markets where we buy mostly from larger funds.
Awesome. And then something to consider when we look at notes is we talk a lot about lien position. So, you have first position mortgage notes, second position tax liens. So can you elaborate on what a majority of our fund invests in?
Yeah, the primary focus is first position, which being in the first. Okay.
No, I was saying, what does that mean?
Being first means kind of like, you're in the front of the school bus. So other people might get a home equity line of credit later on. And if they default on that, we are still in a position to get paid. So if that property were to get sold off, we are the first ones to get paid, and outside of, I'm not going to go into too much details, but county taxes take precedent over everything. So those, of course, get paid first. But after that, we're next in line.
Okay. And so when people are investing in a fund, a mortgage note fund, are they investing in a singular note? Are they investing in the entire portfolio? How does that work?
So they're investing in the entire portfolio. So it's not just one note. We may have 1,000 notes in this fund. So their investment is spread out through the entire portfolio. So it's not, if there was one note that didn't perform as well as others, it's not like that investor was tied to that note.
You jumped the gun there. I was going to ask you, so how is that a positive thing? How is that beneficial as an investor? And you just mentioned it mitigates risk because you're not invested in a singular home or rental property. Your risk is spread out among hundreds, if not thousands of assets. Those assets being mortgage notes.
Yeah, and they're also in different locations, different areas. So similar to like stock investing. Do you invest in one stock? Do you invest in the S&P, or do you invest in a multitude? It's similar. How do you want to handle questions too? Because we did get one that did pop up.
So we are going to hold questions until the end. So if you have them and they come up, feel free to go ahead and put them in there. I, for some reason, cannot see them right now. Oh, here they are, Q&A. Yeah. I will be pulling from these at the end. So if they pop up as we're walking through this, feel free to go ahead and ask them. And then at the end, we'll go through and answer them.
Okay.
So
through the conversation, if it's the right time, I may answer it, and then we can hit back at the end too. So, okay.
So what Chris said too. So, again, so now like a little high level of what mortgage notes are. We do have a podcast where we go way in depth on mortgage notes and everything about mortgage notes. So if you want more details, feel free to head over to the podcast. But kind of moving into kind of the next layer of questions, is how, okay, as an investor, how do you make money note investing? So starting with the, acquisition, something that we talk about a lot is a 3-dimensional approach to, acquiring these mortgage notes, because that is really the most crucial part. We have, and when I talk about 3-dimensional, we have the property, which is really like evaluating the value of the property, the condition of the property. We have the person, so looking at the situation of the person, the, what happened? If they're delinquent, why are they delinquent? Was it because of COVID? Was it because of, a health issue? For the most part, people don't just stop paying their mortgage. So really digging into what is that situation, and then looking at the position. What is the financial position of the borrower? Is this something where we can work with them to come to a resolution that makes sense for everyone? So when we are acquiring these, tapes of assets, we are purchasing them at a discount. And Chris, do you want to elaborate a little bit more on that?
Yep. So that's first a common question we get is, if the note, the mortgage is at like 5% interest, how are you aiming to provide 8% to an investor? And that, the response to that is, we are buying at a discount. Typically, we'll buy loans at a 45 to 50%, 5% discount. So if the loan balance is roughly $100,000, we may be, if it's non-performing, we're in most instances paying between $45,000 and $55,000 for that loan. So by buying it at a discount and getting the borrower on a repayment plan and keeping them in the property while still collecting that monthly payments, it will of course give us a greater yield than that original mortgage note investment, as well as allow us to aim to target those returns.
So we're purchasing them at a discount. What, typically that discount is what, like 40 to 50%. And then when we're looking at those, what is that, we look at those, like I mentioned, that three-dimensional approach, the property, the person, the position.
Yep.
And then once we acquire those, okay, great, we purchase them at a discount. What happens next? Like, what are the different exit strategies that allow us to make money for our investors?
Yep. So that's one of the great things about, I'll use the term, being the bank, is, the exit strategies we have numerous exit strategies. One is, of course, working with the borrower and getting them on a new payment plan. And then once they start reperforming, later on down the line, we can turn around and sell that note to another note investor at a premium from what we acquired it for. Because similar to if people invest in, real estate, buy a fix and flipper, you fix it up and it's repaired, now it has more value. Notes are that's a similar scenario. That's one. Another is instances where if the borrower cannot afford the property or want the property, we could do what's called a deed in lieu, where they give us the property back and we take title to the property. Then we are the real estate holder on that asset, and then we can sell it, we can rehab it, we can turn it into a rental. Basically, many different options, because then we, of course, own that physical component to the real estate. And I'd say a small number of the cases, we do proceed through a foreclosure as well.
Yeah. And kind of to put it in perspective, again, we talk about this on the podcast. We've, done whole episodes on this. To put it in perspective, as far as like, okay, how many people if we purchase 100 notes, I would say 30 of those are 35, we'll say 35 are performing, which means, again, that they're paying on time, they're making their payments. So we're just assuming the position of the bank, those payments come to us. Then you have the other 65 that are non-performing, again, being delinquent, whether it's 60, 90 days or a couple years. And then of those 65, typically we're able to come to some sort of resolution, whether it's a loan modification, a refinance, a trial payment plan into a loan modification, a deed in lieu, again, having those multiple exit strategies with all but maybe 10 of them. And those last 10, maybe they'll go to foreclosure. It could be not necessarily even because of the borrower. The borrower might be deceased. It could be a vacant property. So really, when we're talking about foreclosure, because I think this is one of the things people think about a lot, is like, oh, you just foreclose. No, that's not the case. We really work with the borrowers. And then of the ones that do foreclose, it's, a very small amount of the portfolio that make it through foreclosure.
Yep. Yeah. And I've done analysis that we can share other videos that shows, rehabbing the borrower and buying at the discount is a win-win for not only them, of course, but
Mhm.
also for us from a financial perspective. So it's in everyone's best interest to actually keep them in their home. And we invest in mortgage notes to work with the borrowers and be the lender, not to try and be the landlord. It's the reason why we
Yeah.
got into notes.
Yeah. I was just going to say, like, the reason you get into note investing is so you're not a landlord. You don't want to be a landlord, because if you
Yeah.
wanted to be a landlord, you could do that in a million other ways.
Mhm.
So that is not kind of our overall strategy. So leading into kind of, nicely into what are some of the risks, and how does Seveney help mitigate or alleviate those risks? So,
Mhm.
basically in short, how can I lose my money? Which comes up again quite a bit on calls, which again makes sense.
Mhm.
Let's talk first about the property value
Okay.
and how that can be a risk.
Yeah.
And even tying it, Chris, if you could, to today's market where we
Mhm.
are, because I
Mhm.
think with today's economic climate, people are more hesitant. They're kind of on edge of what's going to happen, with the real estate market, with interest rates. So kind of keeping that in mind when you answer my questions.
Yeah. So as a lender, we do not get access to the inside of these properties. So our evaluation is based off of exterior inspections from the street. So we don't trespass on these properties. So that, of course, is a risk because you don't get a full walkthrough you don't get to check the HVAC equipment, you don't get to check this. But we take that into perspective when we're evaluating these assets. First, we send two companies out to inspect these properties, to take a look at them. So we get different perspective, basically in case one missed a photo, whatever the case may be. So we're always putting two sets of eyes on that asset. And then we use several different software programs to run what's called it might be a CMA, comparative marketing analysis. What is that property worth? And when we do that, we're basing it also off of we're not basing off of the brand new home or the home that, especially on a defaulted loan, we're not basing it off of a house with a brand new kitchen and baths. We are basing it off of the homes that might be, need a little bit more repair. So that is one area from the property. And when we're evaluating in today's environment where home prices have shot up over the last 2 years, we're actually also discounting numbers from today's value because, based off of our research and our market studies and the professionals we engage with and talk with, John Burns Associates is a very common market analysis company who provides not only by the market, but overall in other companies, where is real estate headed? And that prediction is, prices will be softening in some markets. So we're also taking that into account.
Yeah. So essentially acting more conservative in what we think the property is valued for when we're acquiring it, to take into account what might happen in the future and buffering kind of our exit strategies. One thing you didn't mention go ahead.
I was just going to, one thing mentioned, you might be saying it, but I was like, oh, I forgot to mention this. The other component is typically the properties that we look for, the loan balance could be 150,000 and the property value might be 250. So the most we can get paid is 150. It's no different, if they go to refinance, we're the bank, we get paid 150. So if that $250,000 house came down to 200, came down to 175, we're still owed 150. So we could see drops in that instance of 30%, and it has zero impact on us.
That, and again, we're buying these at a discount, so we're not even into it for that full 150. So property value. One thing you didn't mention that I know we do as well is sending out, if it's an area that doesn't have a lot of comps, or, besides sending out the two companies to take pictures and give us kind of their eyes on what the property condition is working with a local realtor in the area who might know the area to send us a BPO of some sort.
And then the other thing I'll mention while I pour my water, I can do two things at once. Snap this for my wife, please, is insurance.
Yes.
So if the property, a lot of times people aren't paying their mortgage, they may not have insurance on the property. So we make sure we put insurance on the property to cover the replacement value of the asset. We have had on instances defaulted properties that did burn down and we got covered through insurance. on those assets. So we got our, the full payoff of the loan based off of that. So that is another aspect of the property that we do make sure they are insured.
Yeah. At what point are we placing insurance?
The moment we buy it, what happens is we wire the money and then we notify our insurance carrier. What they do is they send letters to the borrower. And if the borrower provides insurance, then we just get refunded our payment. But if the borrower doesn't provide copies of insurance, then it's retroactively based off of our acquisition date.
So that's one risk, is property value. And how we talked about how we mitigate it, really making sure that we are getting a thorough assessment of the property, and even kind of being conservative in what we will value that property at.
Can I jump in one more time? I'm sorry, on property value. So one of the things that we briefly touched upon it, but a lot of other people might invest in like single family rentals or everything else. And a lot of times they are putting 25 to 30% down and then getting the rest of that money from the bank. So they only have that 25 to 30% equity. When we're buying a note with the property that has equity, or even if it didn't have equity, at 45 to 55%, we're already in a much better position, if there were to be a reduction in that property value. So I just wanted to make that comment.
So and to kind of give an example. So if there's a $50,000 loan, unpaid principal balance, we're acquiring it for say 25, the property's worth 100, even if it drops by 50% to 50,000, which would be, a huge drop. We still have equity in that property. So just kind of to give an example of what you're talking about. The next thing I want to talk about when it comes to the potential risk is time. Now, time, we all know, time is money. And how do we mitigate that? When we're doing our acquisition, going through our bidding and forecasting, what we do is we forecast for longer time periods to reduce the risk. So again, a lot of this really ties back to the acquisition and doing, a thorough job on bidding these and, assessing the property, making sure, being conservative in our value of the property and how long it will take to kind of come to resolution on a property. So Chris, in your experience, what would you say is the average time frame it takes to bring something from once we have acquired it and it's, boarded with the servicer to like resolution, whatever that is, whether it's, loan modification or refinance?
Yep. Typically it's about 12 to 18 months. If, typically the ones that begin to reperform, those are the ones that usually take longer because it'll take several months to get them on a plan. Then we'll give them about 12 months of consistent payments before we modify the loan. And at that point in time, we can look to either keep it for the cash flow or sell it for future reinvestments. But like you mentioned, when we provide, when we input stuff into our calculator, which I like to think is pretty robust, we're using conservative numbers. If a state has a timeline, if it's a non-performing loan, and we forecast it as a reperformer versus a foreclosure, we're always going to take whichever one is kind of the worst case scenario. And then if a foreclosure, for example, in the state of, Indiana is 12 months, we will typically within that calculation carry, probably a 25% contingency on that as well. So we will carry 15 months. And you mentioned the acquisition, but the whole management side of things with Delaney and Chi and our asset managers staying on top of our companies that we use, especially the attorneys, to make sure the paperwork or anything that has to go through that process is being done. And even the small things like getting a modification done with a borrower and sending it to them, or having a mobile notary go out to them to sign it to get it back to us. Because sometimes, lessons learned, you mail it to them, it gets lost, the dog ate a piece of paper, and next thing you know, it's 3 months before that agreement happens. So we found ways to definitely fine tune everything and expedite the time, because in this business, time is money. Investors were aiming to get 8%, every month there, if we're not progressing on that loan, that is money that's going out the door.
Yeah, I think that's a good point you made about not only, I talked about the acquisition and, doing a thorough job there,
Mhm,
but also the management of it. That's why it's so important that you have a solid team.
mhm,
And we really
mhm,
do. So, like I always
mhm,
say, definitely look into who you're investing with, not only like what you're investing in.
mhm,
Because without our awesome
mhm,
asset management team, those,
mhm,
loans, we wouldn't be able to modify and move
mhm,
through loans as
mhm,
quickly without such a great team and systems and
mhm.
processes that they put in place. So,
Yeah, and we've taken, from our prior loans, we've owned hundreds and hundreds of loans in the past. So we've been able to constantly fine tune our processes. I'll use the if this, then that situation, when to follow up, when to do everything. So to me, I think it's, between the staff and the SOPs we have in place,
yeah,
it's a well-oiled machine.
yeah, I agree. Next risk or possible risk would be superior liens. And we touched on this a little bit when we were talking about different lien positions. And you
Mhm,
brought up, county taxes and
mhm,
tax liens take precedent. So, can you talk a little bit about how we mitigate that risk, both
mhm,
in the acquisition process and in
mhm.
when we're managing it?
So similar to if you were going to go buy a property and get a loan on that property, a title company would pull a title report to make sure you have clean title. As a lender, we are also doing that same thing. When we go to acquire a loan, we are pulling a title report from a title company to review that report. We have two groups internally that review it. So we have two separate reviews internally that review it. And then we have a third review, which we actually send it to an attorney licensed in that state to also make sure there isn't some type of quirk regarding a power of attorney that was needed to be recorded or some other type of issue that may show up that we did not pick up. So we kind of have a three-pronged approach on the title component during acquisition, where we have two departments internally looking at it, and then of course we get the attorney to review. And then, as you mentioned, delinquent taxes, is the ace of spades, or it trumps everything that can wipe out your lien.
Mhm.
So one of the things that we do is we have a third party company that we've engaged, and the only thing they do is they deal with taxes.
Mhm.
So they are connected with every single county across the United States, and they will, at least once a year, right before taxes are due, they will pull from the county the taxes on the property to make sure if they're paid or delinquent. And after delinquent, they'll say, Chris, you got to get these paid. And then we will go out and pay them. And then they will pull again 6 months later and let us know, okay, confirm they were paid, or did the county not cash a check? And if there's a mistake made on their end, that they, missed something and so forth, they actually have an error and omission policy that would protect us.
Awesome. Now, so you kind of talked about the title as well as the taxes in that one, which was my next question. But
Mhm.
other mitigation things we do to mitigate risk. Can you talk about why we do not leverage our notes?
Uh, One of the reasons we don't leverage the notes is, well, one, there really isn't a need to, because we are the lender in this instance, and we're already in control. So that's one aspect of why we don't, leverage those assets. To answer that other question, you kind of said some of the other risk mitigation features you do.
Mhm.
Uh,
Yep.
Typically, every fall, probably it'll be next month. We have inspectors go around to every single property that we have and just do an inspection. Is it still occupied? Are people still living there? Just making sure we're checking in on the property to get eyes on the property. If we notice something, we may have the servicing company, who is the company that collects the payments for us and deals with the borrower. We may have them send a notice that, hey, we noticed this, and want them to look into it. If it's a roof repair, kind of make a comment, things along those lines. So that's another aspect. Another, again, is we use a third-party licensed servicer, so we don't deal directly with the borrowers for consumer laws, fair debt collection. If people ever heard the term Dodd-Frank from a decade ago, that implemented a lot of laws because of the downturn almost 15 years ago, where there's a lot of things going on both sides with lenders, mortgage loan originators, and so forth. So those are some of the other aspects. We've got systems in place again for risk where software systems that we spent money on to manage our portfolios as well. But we don't rely on just that technology. We have human beings, asset managers, real people actually managing the assets as well.
Yeah, I think that's something that's super important because, when I remember back when I was getting started in note investing as an individual investor, your first question is like, where's the bid calculator? What Excel can I plug this into and give me the answer? And that's, you can do that, but there's nothing that will replace the human experience, the knowing that New York operates very differently from Florida, from California. Each state is so unique, and knowing where the market is now and following that, nothing can really replace the human eyes on each asset. So yes, we do invest in technology because technology helps move things quicker, but we always have human beings working on each asset. So I think that's super important because you can only, I can't think of the word.
Okay.
You can only automate. I was like, what's that word? You can only automate so much. So one thing you didn't mention, well, we mentioned earlier, but I want to reiterate, is we invest in a significant number of assets. So not one or two assets. So unlike, a multifamily syndication where it could be, 200 units, yes, each unit will operate differently, but overall they're not independent. Whereas each note that we acquire is independent of the next. So again, kind of mitigating your risk. You're not tied to one specific note in New York, so to speak.
Yeah. And we've also invested in over 40 states. So it's not like we are state centric or state focused where we only invest in 2 or 3 states. We spread out through, the different states. Now, some states are more lender friendly than other states. But in those states that are not as lender friendly, again, we mitigate the risk by discounting that asset more than a risk other types of states. For example, New York. New York is a state that is challenging for lenders to do business in. So a note in New York would be significantly discounted compared to a note in Virginia, Georgia, Texas, which the legal process can be done in 3 to 6 months. New York, you might be 3 to 6 years, to give people an idea.
Yeah. So again, and that comes back to knowledge of having done this for a while, also knowing that I think the team, again, I come back to the team and the relationships we built in not only the industry, but across the country when it comes to, building out legal contacts in every single state. Every state is different. The rules are a little bit quirkier on what you can put in a loan modification. And so having those experts that we can work with is an important part of what we do as well.
Yeah.
So,
and I do the rule of 2. I always have 2 of something, and whether it's we do work with at least 2 servicers, we work with 2 attorneys in every state. So pretty much if something were to there are concerns or issues with one of our vendors in any aspect, then we can easily make a shift because we're always working with multiple parties, especially attorneys. Over the last years with COVID, a lot of them weren't allowed to do anything. So they had a lot of turnover with staff and things happen that may have changed our outlook on working with, an attorney.
Yeah. So that kind of wraps up what we wanted to discuss as far as, okay, what is a note? How do you make money and what are the risks? So now I am going to open it up to Q&A. I do have quite a few questions already that have been dropped in here. So I'll go through and ask some of those. So the first question we have is, do sellers only sell bad notes, meaning ones that cannot make money?
No. So I'll expand on that. But I just wanted to kind
That
of,
might be the shortest answer I've ever heard you give.
yeah, little emphasis attached too. A lot of people get that misconception, like, why would you sell this note? And there's many different reasons. For example, we've recently sold some notes, and they were in, for example, we had, one note left in this one state. And, it's like, okay, we don't have any notes coming down the pipeline in that state. Let's just liquidate that so we don't have to kind of deal with that state. Some of them have been paid off over time. So those balances have come down significantly. And okay, we can liquidate this now. The risk versus the reward, we weigh that out. And it's like, okay, we're at a time where we could sell this one off at this point in time. And a lot of large institutions, will take, when they buy that big tranche, people have to remember, it costs the same amount of money to manage a $1 million note as it does a $20,000 note. So if a fund bought $1 billion worth of notes, and they had 1,000 of them that had balances under 100,000, they only have so much staff. They're not going to go hire more people to manage those lower tier loans. They'll be like, we can sell these off, and we'll make still, because buying that much, they're buying at an even better discount, sell those off, make money, and then they filter their way down. So there's many different reasons why. And we, during our due diligence, we can pick up the fact of, sometimes we can see, oh, I see why this one's selling this property, because there's no roof on the back of the house, or this borrower has filed bankruptcy 7 times, and this loan is just going to be perpetually in that that cycle of not getting to a resolution.
This one, I believe, is in terms of the specific fund. Can you describe the liquidity of an investor?
Yep. So with the fund, you're buying shares, which there's a 4-year lockup period. Shares are transferable, meaning you could transfer shares to somebody else. They are not listed on they're not listed on OTC, over-the-counter stock exchange. So, I would not describe them as liquid. I would describe them as transferable.
Okay.
Which is different than a syndication. Syndications, by the way, typically you're not allowed to transfer. So I just wanted to kind of make that one little difference.
Yeah, some of these we answered, but I'm just going to ask them just to recap. Where do you buy your notes from, and do you own the home when buying a note? So no, you do not own the home. You own the note, which is secured by real estate, which is secured by the home. And where do we buy our notes from? Larger institutions or hedge funds, which we covered earlier. Do you track how accurate your assessment of a property's value when you acquire it versus when you have to foreclose on a particular property, if you have to foreclose? Do you have historical data on this? How good are you at this?
This is a great question.
Good job, Hugh.
Yeah, this is a great question.
I knew Hugh would bring some good questions. Yeah.
So as a background, I'm a civil engineer by degree. So engineers tend to be, like to assess everything to probably overkill. So yes, we do assess what we anticipate it was versus what it was at foreclosure. And we even look at, during that time period, if we bought a loan in 2017 versus, today is 2022, over 5 years, what has that value been? But $150,000 property, if we guessed in 2017, is $150,000 today. But all the homes in that area went up by 50,000, that we take all of that into consideration. And like I mentioned, we've bought and sold over 500 notes. So we have all that data that we've been analyzing, and it's led us to, over time, continue to fine tune and improve. For example, early on in my career, we did look at some vacant assets to kind of gauge what those looked like. And those are the ones that primarily have the lowest drop in that value, because the insides might have the most damage. So now we just stay away from vacant properties because it gives too much of a risk factor. But yeah, we do keep a lot of that data that we do have. But I'll also mention, like Lauren said, the foreclosure rates are very low for what we foreclose. We buy a certain percentage of performing, and then a lot of them, We do buy where we keep the borrowers in the property and work out some type of agreement. So it's, we do have the data, of course, but it's not, just want to make comment that not every home we do foreclose on.
Yeah. I mean, I think this is interesting. And until I really got into the industry, I was shocked by this.
Mhm.
Something you mentioned earlier is, people don't know that your loan can be sold. I mean, even if
Mhm.
you're paying, my
Mhm.
loans, our note has been sold a ton. So, sometimes when you're looking at these non-performing, you have to
Mhm.
send what's called a welcome letter,
Mhm.
welcome, I'm your new lender. This
Mhm.
is where your payments go. And there have been borrowers who literally just their
Mhm.
loan has been sold so many times that they're like, oh, like one, is this a scam? They'll call the
Mhm.
servicer, and then it's just as easy as like, oh, I
Mhm.
didn't know my loan was sold so
Mhm.
many, I couldn't keep track of it. Like
Mhm.
I've been trying to figure
Mhm.
out where to send payments.
Oh,
So that happens more than I would have thought.
I've got one that I'll just briefly mention where there was an elderly woman who filed Chapter 7 bankruptcy because she had medical bills. And in a Chapter 7, you get relinquished of your debt. You no longer owe any of that debt. But if you still have a mortgage, you have to do what's called a reaffirmation agreement, which is reaffirm that debt, or the lender can still foreclose on the property. You don't get a free house. Well,
Mhm.
this woman didn't know any better. And she's like, oh, I thought I got the free house. Nobody contacted me. It was literally 7 years. This woman was just not getting any notices or anything. We acquired the note, and we basically reached out to her and said, hey, look, just want to make sure, hey, she gets a notice with the debt. She calls up and she's like, yeah, I didn't think it was. Could you mind, she told the servicer, that if she could contact her attorney. Of course, they, recommend she does. And the attorney's like, oh, yeah, you're still supposed to be paying that. She's like, oops, this is probably, I think, like 2 years ago plus. Never missed a payment since. Basically, just has the money ACH'd every month and was, hey, I didn't know and nobody asked me. So kind of out of sight, out of mind. It's a lot, like you said, it's a lot more common than I thought it would be when I got into
Yeah.
this business.
Yeah. 100%.
Mhm.
Um, How do you collect? Another question. How do you collect on a note? Do you collect the payments directly from the borrower?
Yes. So no, we do not collect the payments directly from a borrower. We
Well,
use,
yes,
sorry.
we do, but Seveney does not. We use a licensed servicer,
Yeah,
but like we assume the position of the bank, the lender. So the
mhm,
payments are going to us. However, they're being sent to our servicing company.
correct.
Yeah.
Yeah.
I didn't
So,
know how I just want to clarify for that question.
yeah. And the servicing company, they're responsible for breaking up how much is principal, how much is interest. If they're escrowing the loan, they handle that whole process for us.
Um, so another question we have is, if the current mortgage rate is 6%, how can you pay your investors 8% and make a profit?
Okay. So this goes back to buying at a discount. When again, we go back to that $100,000 loan, if we acquired that loan for $50,000 and manage it on, get the borrower on a new payment plan, 2 years later they may have made 10,000 in payments. We turn around and sell that on the secondary market for 75,000. Basically our returns on that loan would be above that 8% return, and of course above that 6% interest rate. Even on the performing loans that we buy those, those have less of a discount, but those typically might be at like 75 to 80 cents on the dollar. And a lot of those loans are at 8 or 9%. And I know people ask that question, well, how could somebody get a loan at 8 or 9% when interest rates were 3 or 4%? And I remind people, 3 or 4% are for the borrowers who have, 700 plus credit scores. If you're at a 600, 620, you're considered a higher risk. So those rates will be higher.
So I have a few more questions that are kind of all similar. So I'm going to ask them, kind of summarize them for you. But with the reserve raising rates and real estate values starting to drop, how will this alter, if it will, your investment process?
Yeah. acquisition process or yeah.
Yes,
Okay.
I think it's what they meant.
Yeah. So like we mentioned early on, we've already started within our models to discount some of the values of that property. One of the things that is very important as part of note investing, and you touched upon it a little bit, Lauren, is, people, if they're in their house and they have a job and they're able to afford their mortgage, that, if that house value drops by 20%, like if your house or my house dropped by 20% right now,
Mm-hmm.
it's okay, it dropped 20%. I still have a job, I can still pay my mortgage. We also follow closely the unemployment, because as employment starts to get up, people, and inflation is important because people might not be able to afford those bills. That is another indicator that we look at. And as part of our due diligence, we're evaluating, like, you called it that, the
three-dimensional approach,
three-dimensional approach. Yep. We start looking at that individual. Okay, can they keep making those payments? What is that risk perspective to make sure? And if it's a loan that is performing, but we think it's a high risk to go non-performing, then we won't buy that loan, because it's too high of a risk for us.
Mm-hmm. Yeah. So really focusing on jobs and inflation more than the interest rate of lenders.
Yeah. Mm-hmm.
Let me see. There were a lot of questions similar to that. So I kind of put those all together. Oh, do you own the home and buy? Let me see. How many years or months have your interest rates been bigger than 7%?
So I'm guessing that is probably on the loans that we acquire. We've seen loans. So back during the HAMP days, which is when the government did the modification programs, homeowner assistance modification program, we've seen them as low as 2% on the modifications, up to as high as, typically they go a little above 9, and that has been throughout loans that I've seen originate anywhere from 2000 to loans today. It's been a vast spread on those loans that we've seen.
Okay. And you kind of answered it. What is the lowest interest rate in the last 5 years that you've seen?
Yeah. I've actually seen some actually down to 0, which typically when there's 0, again, we will pass on those, because when you think about it, a borrower has, if they are delinquent or having trouble paying, there's no ramifications. It's not like there's any extra interest or the interest is accruing. It's a 0% interest. So it's kind of pay as you go. And in a lot of those instances, the payment could be low. It could be like $500 a month. And let's say they get 4 months behind. They owe $2,000. If you have an attorney send a letter of demand, then they just, okay, here's your $2,000. So it's not a constant cash flow or payment. You're constantly going back and forth. And those are the types of loans that over time we've learned are not the best suitable for something we'd be interested in.
This next question, this fund is just starting. Do you have a track record of operating these types of funds in the past?
Yes, but
add your disclaimer.
Yeah.
I'll add the disclaimer.
Go ahead.
So, yes, while, past performance is not indicative of future success, we have operated several funds in the past, Regulation D offerings, which is different in that we could only raise money from accredited investors, whereas this offering is open to both accredited and non-accredited investors. But in our, again, keeping that disclaimer in mind, in our past funds, we have never missed a commitment to our investors.
Yeah. So, yeah. And that's.
Nor lost principal.
Yeah.
Like, again, past funds, not future performance. We have to have that disclaimer for you. But yes, that to answer your question.
Yeah. That 3-letter agency called the Security and Exchange Commission. We have to be, careful on what we say. Again, we don't make guarantees. And yes, we have experience in the past on running these types of funds, these types of assets. And you've already answered that. So I would love to tell you more, but I can't.
We answered this question, but how do you make money when you buy a note where the borrower is not paying?
Yep. It goes back to that multitude of exit strategies where when we buy it, again, the three-dimensional approach, we try and work with the borrower to get them on that payment plan, to try and modify the loan to have them start paying. If they unfortunately can't start paying, if they don't want to, use a proverbial term, play ball, sometimes we may have to get legal involved and, use the terms of the mortgage to try and redeem that property. So like I said, by buying it that discount, we have that multiple exit strategies that we look to go through that we talked about earlier on with the borrower. But we do not just sit there and, twiddle our fingers.
Which
we're
brings,
always, go
yeah.
ahead.
No, well, because I'm sure you could keep going, but you
Sound confident in that statement.
very confident. So something you touched upon a little bit, but I think is important is you talked about the borrower, for example, you give the example of the Chapter 7 bankruptcy, and the communication really was the missing piece there.
Mhm.
And I think that's something that people forget. It's not a big part of it is just the communication. These people either might not have been contacted. People will buy notes and put them in a drawer before we get them. And they're like, wow, you called me. Like, yeah, I'm willing to, let's like come to some sort of resolution that makes sense. I've been trying to figure out where to pay, or I had this health issue come up, so that's why I stopped making payments. So again, that communication and those systems and processes that we have in place to actually reach out and like extend an olive branch to the borrowers, I think makes a big difference as well. And it's something that it seems so simple, but is not done by a lot of people, as is evident by your Chapter 7.
Yeah, and it even goes to the extent where we all get lots of junk mail. So if you're getting mail from a place you don't know, 90% of my mail just goes into recycling. So we've even gone to the extent of, we'll, through the servicer, send out a door knocker, which is a third-party company where they'll literally knock on the door and be like, are you, John Doe? I'm with XYZ company regarding ABC. And they'll literally be like, here's the phone, and it'll be the servicer on the other end, basically saying, hey, we've been trying to reach out to you. We don't have your phone number. So whether it's via, letter communication, phone communication, or physical contact, meaning, face-to-face, we'll exhaust every single effort to try and get, in touch with that borrower.
Correct. Well, with that, we're coming up on the hour. So any final thoughts?
No, I'm just going through some of the questions. There was one question at the bottom, that the difference between the Class A and Class B shares that we are offering. I don't believe we have a Class
No,
B.
it's Class A and bonus shares is what
okay.
we're offering. Yep.
Yep. So Lauren can give you all the information on the share types and the bonus.
Like I said, I know I've spoken with a handful of you, and I'm glad you guys were all able to join us today. If you haven't spoken with me, or you are interested in learning more about our specific offering, feel free to, you can send me an email directly at invest@seveneyinvestments.com, and I can send you a link to book on my calendar. Or if you're interested in hearing about our past offering, but don't necessarily want to get on the phone yet, email me and I can send you a link to our last webinar we hosted, which talks all about the details of our specific offering. So that being said, thank you all for joining us, and make it a great day.
Thank you all. And I'll just add one more thing for those that's still here. If you did have a question that you feel was not answered to the full extent, or whatever the case may be, reach out to Lauren or I, and we'll happily get that question answered for you.
Yes. Awesome. Thank you, and have a good one, guys.
Thank you.
Bye.
Bye.